This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. So today on the show, I have Mebane Faber. Mebane has been on the show before. Yes, those are motorcycles. I hope you can hear them. I've decided to go outside and come up with some Saigon street noise to introduce Mebane. I'm not really sure what Saigon street noise has to do with Mebane Faber. Mebane Faber is a smart guy. He knows a lot about quant stuff. He's got a bunch of books out. You have to read his books. I think our podcast will be fun. Enjoy. What's going on? How are you? You just got back from the East Coast, yeah?
Late last night. I got delayed in Cleveland, but was in North Carolina. Did it's kind of a nice work fun combo. Did 3 days giving talks to the local CFA societies, and then 3 or 4 days at the beach with my family at a little tiny beach in North Carolina called Topsail Island. That was pretty fun. So back to reality late last night, but it was fun. It was a good time. You ever spend any time in North Carolina at all?
Yeah, Duck and Nag's Head and that kind of stuff.
Yeah. Nice beaches there. It was perfect weather. Went fishing, did some flounder gigging, which I had never heard of before, where you go out late at night and look for flounders on boats with spotlights. Anyway, it was fun.
Well, I tried to get a very special open for you tonight, and I just think it's going to have to go in the outtakes at the end of our episode, and you'll have to hear it on the. I was trying to get these young ladies that work at my residence here to downstairs, some of the staff, to kind of give me an introduction. I said just say this is Michael's podcast, and introduce Mebane Faber coming onto the podcast and do it in Vietnamese for me. And it was like there was a whole powwow where they were speaking Vietnamese. They were debating this. I think they actually asked for money.
That's funny. That's funny.
We couldn't get it to come off, but you can hear the negotiation when the podcast goes.
It would have been good at the very least to hear them try and pronounce my name. You get out of the South, it just usually gets massacred one way or another. But yeah, especially. So wait, you're where now?
I'm in Vietnam.
Awesome.
Now she did. Hold on. She did say it. She did say it. She wasn't reading it though, and she was not sure. And I think that I'll just let you hear what she said at the end. Though. It's good stuff. It's good stuff. So I'm in Saigon right now. Great.
I haven't spent hardly any time in Southeast Asia. It's on the to-do list. But haven't been over there. Spent more time on kind of, this side of the world, but it's
tough living in Manhattan Beach.
Yeah, right. I got a few international trips planned this year, but so far none over there.
It's interesting. I was traveling around quite a bit this spring, and but there is an appetite for the quant style of trading here. It's not widespread acceptance or usage, but there's definitely an appetite. I think the Chinese definitely are leading the way in terms of that appetite, at least from what I saw. They see an opportunity to make something work, and if they can wrap their arms around it pretty quick, and it's a gambling society, they're in.
Yeah, right.
So
all they need is another fat, equity run up, and then there'll be traders everywhere.
Well, you know what it was is they're very used to the idea of big parabolic moves on companies with funky, not real balance sheets. Right. So they all kind of see these moves, and they're looking for a better way to trade these basically companies that aren't legit. Kind of like our .com experience all those moons ago.
Right on.
So let me jump right in. I saw something on your site that I thought was kind of cool, and I want you to kind of explain what your thinking was. It's definitely a kind of a different type analogy, but you said asset allocation is like bullets. And I thought that was really cool with the imagery and whatnot. I think I know where you were going. You were kind of, you didn't really say much, but why don't you explain what your thinking there was? And people should go look at this, your July 1st entry on your website, Asset Allocation is Like Bullets.
Well, we've done a lot of posts on asset allocation, and being a younger guy, most people manage money based on the markets they've experienced. But a lot of people, what you really need to do is study as much history as possible, right? And what this was from is that there was a artist that went in, Sabine Perlman photography, and just did cross sections of historical bullets and just showed what's inside, whether it's ball bearings or other types of gunpowder, whatever the casing inside the bullet was, and just go to show how incredibly beautiful and intricate, but also how different all of these simple bullets were that largely had the same purpose. And, you always hear investing or trading is like X, and people love talking about baseball or poker or whatever. And I was just trying to come up with a lighthearted reference to this beautiful photography. But it's amazing to see the differences in design and how much people spend on asset allocation to really come up with the same purpose. And that's to come up with a portfolio that largely performs in any market, preferably, performs well in any market and over time. And as a follow-up to that, and we're going to there's been so much interest in this topic, I'll probably do a white paper, a book here in the next month or two. But we went back to the 1970s and looked at about a dozen different guru-type asset allocation strategies, right? So everything from the basic 60-40, which is 60% stocks, 40% bonds, to the endowment-style portfolio, to the permanent portfolio, to I'm trying to even remember what all of these were. Let me pull it up. To the 7-12 portfolio, to risk parity, which has been a pretty popular topic, and then a few of the big names: Bernstein, Tobias, Arnott, Arian, Swinson. And what we found is, and this is from like 73 to 2012, that they all had these totally different percentages. One would have 60% in U.S. equities and 5% in commodities and 10% in real estate, 20% bonds, whatever. But for the most part, they all were within pretty clustered range of compound returns. And if you looked at the total range was something like under 2 percentage points.
So hold on, their allocations were drastically different, but their returns were pretty close?
We're pretty close. And so if you look at the volatility, it was pretty close. You look at the Sharpe ratios, and there were some minute differences in certain things like drawdown and the volatility, but a lot of that is regime dependent. So the ones that had more in bonds, obviously, over the past 30 years in the U.S. have done better in this sort of, bond bull market that you're not going to probably see again, as bonds have gone from double digits down to very low levels. But in general, a lot of them clustered. And the reason why is you have all of these asset allocations are expressing one view, which is largely long assets, right? Long financial or capital assets, stocks, bonds, real estate, commodities. And, even though they were designed differently, sort of this beta sort of allocation, right? Just like what Ray Dalio at Bridgewater calls this all-weather beta portfolio, ends up with a similar result. And there's certain markets that typically does pretty bad in, like a 2008, that if you're just long, and 60-40 is a classic example, because every major country in the world has had at least a 2/3 drawdown in a 60-40 portfolio. But just goes to show that, if you're buying and holding assets, typically you're going to come up with pretty similar returns over time. And that differs.
I'm guessing too that those guys, even though they might have been advertising or promoting to investors how drastically different and special they were, it's interesting that they did that over the decades. I mean, I'm assuming they were spending a heck of a lot of time telling everybody how different they were and the perspective they had and all this frankly, extra fees that were probably paid to here and there. But the reality is, at the end of the day, they got the same results.
Exactly. So if, what we have been telling investors for many years is that if you're going to buy and hold a portfolio of just asset classes or beta, you can do that on your own. You can go buy 10 ETFs or mutual funds, pay as little as possible. So you can do a portfolio for probably 0.2%, 20 basis points. And we actually have had investors over the past 7 years come to us and say, hey, can you do this? And I say, look, you don't need to pay me to do this. Like, you can do this on your own. Now, I'm happy to do it for you, but literally you could, here, 5 minutes, I'll tell you 10 funds to buy and go away. Like people in general don't need someone to do this sort of asset allocation work. Now, they could pay someone to keep them from themselves, where they're potentially, a detriment to their own, trading and investing. But in general, a lot of these guys that charged 1-2% for buying whole portfolios, brokers back in the day, it's kind of borderlines on criminal, and they don't do enough to really justify their fees.
Let me jump into something that I think is at the heart of probably your probably at the tip of your brain on a regular basis. And if we were to talk about what are the benefits of being a quantitative systems guy like you are in my world, quantitative systems. And I know, and you're going to run with this, but ultimately it's helping people to kind of protect themselves from their own innate biases. There's their own innate behavioral issues that they, frankly, consciously, subconsciously, but isn't that the real ticket? What a quant system gives you? I mean, you already mentioned the fall of '08, but isn't that what it really gives you? It gives you kind of a way to benefit from those biases that you have, kind of almost like handcuffs to keep you going in the right direction.
Right. And, the study, I started out studying biology and loved the sort of behavioral side of the world, how irrational people can be. And the funny thing is, I came to a lot of that by starting to realize a lot of my own biases. I mean, I'm highly overconfident. I take on way too much risk if given the opportunity. So becoming a quant and having an objective process, I think is the number one thing you can do as an investor. And so, I think it's actually okay. I think most people would probably benefit from paying a financial advisor or a money manager to manage their portfolio, not because what they're doing is difficult. It's not. You can rebalance it once a year. It takes 5 minutes, but largely because they're keeping them out of their own way. It's almost like a tax you're paying not to go do dumb things, right? 50 basis points in the greater scheme of things is probably nothing compared to probably the damage you'll do to the portfolio. I mean, I can't tell you how many investors I've talked to that say, Meb, here's my portfolio. It's 2010, 11, 12. I went to cash in 2008. I've never bought anything since. These type of, or I bought a bunch of tech stocks in the late 90s and got, lost 2/3 of my retirement, whatever they may be. Paying a financial advisor or an investment manager a reasonable fee to keep you out of your own way, I think is huge. Or having an objective process, and being a quant is part of that. For what we do is being able to say we have enough rules, but also to be open to look at as much history as possible and say, what kind of makes common sense, what is a reasonable, and then how and when can things be different.
What's a good way to bring the average person in? And when I say an average person, it could be a broke college student, could be an attorney who makes a couple hundred a year, but just the whole phrase, behavioral bias. I mean, it's so academic. It is so. I think it probably doesn't it for the vast majority of people. Have they already lost? Fallen out of our world when we bring these things up? I mean, is it really?
I think the key there, and when we give talks, I'll bring up very specific examples that hit home, and the very classic ones are, the vast majority of people think they're better looking than average, or better drivers than average, and so these sort of biases, and then. The example I often give when I'm talking about money is that the very real feelings you have when you're making money and losing money. And people can resonate with this. Now, it's only people that have been through it. So, for example, typically the older people are, the more experiences they've had in making and losing money in the markets. But they can resonate when I say, hey, look, remember back to '07 when you were buying that second and third house, or you're like checking your E-Trade account 3 times a day, or you're telling your neighbor about how smart you are investing in China or Brazil, or you love, buying into commodities, whatever the asset class du jour is. And then the flip side is remember the very real pain of the fall of '08 or 2009 or 2003 or, all these other times in history where you didn't even want to open your brokerage statement. You just threw it away. Or you said your neighbor is such an idiot for telling you to buy that biotech stock, and the pain you feel. So there's a lot of, in the flight response, right? You just want to run away. So once you kind of show someone some of these very real world biases, and they start to say, oh, aha, I've done that, or, I can relate to that. And there's a couple, James Montier has some great books on the topic. There's a lot of good books on the behavioral. But once you realize that you can be irrational and realize there's things you can do to take advantage of that also, or at least keep yourself from making really dumb decisions, that's probably the biggest first step people can make in investing.
So question. Right now we're at all-time highs. I can look at a stock chart of Tesla to the moon. Everything's up. It appears by if I turn on the press and look at the media that everything's been taken care of, and there's nothing to be concerned about. And I lay that predicate because one of these debates I have with people is sometimes a lot of pure quant guys will be like, hey, just be quiet. None of this stuff about what's going on in the economy is relevant. And I'm always kind of like, well, hold on. It is relevant because I think you want people to understand about these boom bust periods that happen. I'm not saying we necessarily need to agree on why or how or what the Fed might do, but we can all observe that there's been these boom bust cycles across equity markets in the last 15 years. And do we think that stopped? And I think maybe that falls back into your wheelhouse from a quant standpoint. Like, I mean, look, does anyone really need a quant strategy of any sort beyond buy and hold if everything's been taken care of? And I think that's the ultimate question for people. Do you feel like we will never have another 50% decrease in the S&P?
Well, the bubbles have and kind of always will happen in almost any asset class, especially with equities. And if you look back in history, there's just so many examples. And even, if you look back in the last 10 years, looking at a lot of countries, Greece, Cyprus, Iceland, Ireland, Argentina, I mean, just it rinse, repeat over and over. The names may change, but in general, you'll have these sort of bubbles and explosions. And one of the biggest difficulties we have with buying and holding, is the ability of the individual investors who sit through long bear markets and the length of time that may last in any one individual country. And so it can go on for years and years. And so as we find ourselves here in the U.S., especially hitting all-time highs, and having this fantastic year, U.S. has been outperforming really everything for year to date and even longer, up 20% percentage points this year. One of the biggest problems we have with this efficient market theory is, I was giving a talk to a CFA society this past week and said, most people could sit here and say common sense, looking at, for example, being a quant, I'll take anything that really works. And so I use fundamentals, I'll use technicals. Fundamentals mainly as an anchor, but say looking at long-term PE ratios, so the 10-year PE ratio for a lot of countries, and using that as an anchor and adjusting it for inflation. We've built it for over 40 countries around the world. And in general, these countries, the average is around 17. They peak out in bubbles in the high 20s, and you'll have secular lows in the high single digits, so 7, 8, 9, 10. And But you have these huge boom bust periods. So the US in the late 90s hit the mid to high 40s in late 1999 in December. And so you can't sit there and say to a reasonable person, is it a good time to be buying stocks when they're trading at a high 40s PE multiple as it is when they're trading at one around 7? And the classic bubble of all bubbles, the granddaddy, Japan in the late 80s, hit a peak in the 90s, almost hit 100 of this, what we call the Shiller PE or CAPE ratio.
They got to 100 on the Shiller in the Nikkei?
Almost to 100. So I did a chart comparing, the US PE bubble in the 90s, which was a decent sized one, but to the Japan in the 80s, and it just dwarfs it, right? And the reason being is that people, say Japan has had horrible returns, the lost decades, 2-3 decades, and it's because of demographics and real estate bubble, yada, yada. Well, no, it's largely because they had this massive valuation bubble that's taken literally over 20 years to correct. And it's now back down to reasonable, or was 6 months ago, reasonable levels. And kind of where we find ourselves now, and again, this is more of a yardstick, but works great on a relative level, is the U.S. after July, out of the 40 countries we track, is now the second most expensive country in the world. It's at right around 24, the PE ratio. Now, it's not terrible. Typically, it's not horrific. It's not 90s horrific, but it's a headwind. We're looking at, in my opinion, probably real returns of right around the dividend yield, 2 to 3% a year. So nothing, to run away from necessarily, but not great. But the rest of the world, especially bombed out Europe and Greece, Ireland, Russia, Italy, etc. One of my favorites, Ireland, is a lot cheaper. And the rest of the world is actually, so one of our big theses is that, we think the rest of the world at some point, I would have told you this 6 months ago too, will play catch up to the more expensive countries, which happens to be US and others. So, going back to kind of what you're talking about, hitting new highs and et cetera, a buy and hold person would say, we should market cap weight the world. Well, the US is half the world's market cap. So if you're buying global stocks, you're buying half that portfolio in the second most expensive country. Same thing would have happened back in the 80s in Japan. You would have too much money in this vastly expensive country. And so that's the biggest reason why a lot of these market cap weighted portfolios struggle or tend to underperform any other weighting you choose. And it doesn't even matter the weighting really, but just as long as you break that market cap tie. So I think, moving away from the US at this point is probably a really prudent thing to do.
Some of your points sound similar to John Hussman's, some of his work. I don't know if you've seen any of it recently.
Yeah, and John, I've been following for a long time, chatted with him this few months ago up in Northern California. But the challenge with talking about one market in the U.S. in particular is, in the short term, anything can happen. As we've seen this year. If you would ask me in December, where does the U.S. stand? I would say it's slightly expensive. It's a headwind. Marginal returns going forward. What's happened? It's gone up to 20%. And so looking at it on a one market alone on a short time frame isn't really the best use, I think, of valuation. I think relative valuation works much better. So if you went back to the beginning of the year, I gave a talk in Bogota in January, and I said, look, Colombia, I know this is going to be unpopular, but you're the most expensive country we track, equity market. And people pulled me aside in the session afterwards and say, Meb, you don't understand Colombia. Pension funds, they just plow money into the equity market each month and it can't go down. And well, what's happened, of course, it's really struggling this year. But if you look at the 5 or 10 cheapest countries relative to the 5 or 10 most expensive from the beginning of the year to now, the cheapest have outperformed by about 7% this year. But in general, you'll see a cheap basket outperform over time relative to the whole group of 40 countries by about, I think you can get about 4% a year. But, you knowing me is that my favorite combination is not just looking at valuation, right? Because you have that potential of just catching a falling knife. Greece at one point traded at a PE of 10, then it was 8, then 6, then 5, and now it's one of the lowest levels we've ever seen at 3. So you can lose a ton of money just following valuation all the way down, like a lot of value investors did in '08 with financials. But once you start to combine it with a little momentum, and whether that's relative or trends, it's up to the investor. But I think that's really the best combination when you're buying something really cheap. It's starting to go up and starting to outperform.
I caught a headline the other day from Mark Faber. I always have to make sure that if I'm talking to you, I don't screw all this up with all the Fabers and Fabers. But he was throwing out I see on the horizon a 87 style crash in the latter half of 2013. And people are very excited. I mean, there's a lot of people very excited. You see the equities up, and I've noticed just small sample size. I can tell some people are giddy. You can see a little bit of that giddiness. But on the flip side, you get someone coming out and making a statement that, hey, there's going to be a crash. I think the tricky thing is, as you try to be very pragmatic in this conversation with me, you're not just only saying the market is going to go up, and because that's what people just want to hear. But I think sometimes when you have this 360-degree view of what's going on, people might want to go ahead and say, oh, Mebane, he sounds like a bear, or, as we mentioned, John Husband, somebody might say, well, yeah, John, he's a perma bear. And the reality was when I look at work like yours or John's, I just see somebody who's saying, hey, let's look at some of the numbers. I can't tell you what's going to happen. You're not trying to tell anybody what's going to happen tomorrow, but you're saying, let's look at the numbers. Let's have some reasonable idea of where we are in relation to things. And surprise will probably be less surprising to someone that takes this type of quantitative view on investing. I think that's a lot where you go in your world, isn't it?
It's funny because one of my favorite phrases to tell investors is it's important to me to be asset class agnostic or security agnostic. One of the worst things people can do is become emotionally attached to a position, an investment, an asset class. And you see it time and time again. You see it with gold investors, you see it with equity investors, or you see it with real estate investors, and they become emotionally attached to a position. And a lot of going back to the behavioral research shows is that once you've bought something, doesn't matter if it's a car or stock or whatever, you automatically value it higher than before you bought it. Simply owning it, caused you to have this emotional attachment. And so we like to say we're asset class agnostic. Like I don't really care what we're investing in. So one of the challenges with that is, hey, let's have some objective measures to how to buy these asset classes, look at as much history as possible, and when is it prudent to really be investing in a lot of these. We did some posts earlier this spring about REITs being historically pretty expensive. And so the example right now we give, I'm a U.S. citizen. I love the U.S. It's unfortunately one of the most expensive markets out there. Now, there's a slight caveat in that markets, when they're in kind of the safe inflation range of around 1% to 3%, which is where the U.S. finds itself right now, typically they're rewarded with a little bit higher valuation multiple, but it's not as high as the U.S. is. It's usually around 20. So it goes from 16 to 17 up to 20, 21. But once you start to have inflation tick up higher than that 3, but especially 4% level, that multiple can get really compressed. And so it goes down from being allowed to be around 20 back down to 17, 15, all the way down to 10 if inflation starts to get out of control. So the biggest threat I see is starting to have inflation really tick up. And when you talk to Mark or a lot of people that say we see a 1987 style event coming, I can't mention how many times I've heard since 1987, here comes another 1987. And the more people talk about it, of course, I think the less likely it is to happen. markets typically don't repeat themselves the same way. If everyone's looking for it, I doubt you'll see it. However, looking at equity markets, I think, a lot of these bombed out countries, this valuation in general, and it doesn't even really matter what valuation metric you use. Typically, they all end up on the same side when something's down 70, 80, 90%. And we actually did a post recently on the blog that looked at countries, sectors, industries once they've gone down 70, 80, 90%. And not surprising, when you buy these assets after they've gotten destroyed that much, typically you get great returns 3 years on out. And so buying something, like home builders in '08 or tech in '04 or Greece and gold miners right now are probably two good examples. And hold your nose, close your eyes for a few years, buy something and lock it away. But typically you have that sort of blood in the streets or revulsion, nausea that other people have had. And going back to the behavioral, you could take advantage of that by buying something that's universally hated. So kind of where we're talking about right now in the world with Mark, will something like 1987 happen? I don't know. But in your investment approach, I think the correct question to ask is, are you prepared for that to happen? Do you have a plan for if and when it does happen? And are you going to wake up the morning after it happens and then change your plan? So that's the most important question to ask. But there's a lot of others to ask. Are you prepared for gold to go to 4,000 or to 400? Are you prepared for the U.S. to, have inflation ramp up, but also deflation? So being able ahead of time, to have the plan is most important to me.
What you're really asking people is, are they prepared to lose money? Because it's the fantasy that even wise, experienced people want to imagine their equity just goes in a linear straight line up. I think what you're really throwing out there quite clearly is like, hey, it's not going to always go straight up. And how much are you prepared to lose? Because you're going to lose at some point in time. You're going to take a drawdown.
Yeah, and you'll see, and unfortunately, the reality of a portfolio or managing money is there's only two possible states. It's either you're at an all-time high or you're in a drawdown. There is no other potential. So, one of the challenges that people, excuse me, is that you'll often hear people talk about the eighth wonder of the world's compounding. And you'll see so many books that show these charts that if you just compound at 5, 8, 10% a year, you start with 10,000, you retire with $1 million or whatever it may be. But the challenge is, it's like you said, it's not a straight line. And the flip side is true, is that the bigger hole you dig, the harder it is to get out of. And so it doesn't really happen until you lose maybe about 15% of your money, because it starts to really kink after that. You lose 10%, it takes 12 to get back to even. You lose, and it keeps going. You lose 20, it takes 25 to get back to even. If you lose 50, it takes 100% to get back to even. If you get down to Japan, Greece, gold miner level where you lose 75%, it takes 300% to get back to even. So, avoiding the big losses, and I don't think the small losses matter nearly as much, but avoiding the 30, 50, 70, 90, 100% losses is really one of the most important things investors can do.
So I have a question. I'm somewhat on the other side of the planet, and I don't really see much news these days. And so not until I get on the podcast can I help you to get people to understand that you have this new title out, Shareholder Yield, that I'm currently looking at on Amazon, which seems to be doing quite well. What do I need to know? Because I did not have the free Kindle version just show up in advance of my podcast. I'm having to now beg for it now in front of the audience.
Well, if you need to pony up and be a Prime member, because if you're a Prime member, you can download it for free anytime.
I don't know about these clubs. I mean, it's one thing to go. It's one thing to go to Asian karaoke. It's another thing to join Prime, whatever, with you on Amazon. I'm not really sure about that. It sounds a little untoward to me.
I'll tell you. I'll send you a free copy. But the book. The nice thing is it's a short read. We try to condense it as short as possible. So it's only about 60 pages. But we've been writing about this topic on the blog for a long time, and that we think that people that invest, this is a great example of, people always talk about a structural change in markets and is this time different? So in late 90s, a lot of people thought you could now value stocks based on something other than future cash flows, right? Or, the real estate in 2000s was a much better investment than it had been for the past 100 years. And so the question is always being able to step back and say, wait, is this time really different? Has something changed? And so we think investing based on dividends is one of the most basic mistakes an investor can make. Now, it's not one of the worst mistakes they can make. In general, they can invest in companies that don't pay dividends. So they're not doing something incredibly stupid, but they're making a very basic mistake. And the reason being is that there's really only 5 things a company can do when it has earnings and cash, right? It can pay a dividend. It can buy back its own stock. It can pay down debt to the extent it has any. It can go and acquire another company, or it can reinvest in the business. That's it. Those are the only 5 things they can do. And just looking at one of those and making decisions to buy a stock really makes no sense. It really makes no sense to me. It's like, looking at, one side of a quarter, or the example in the cover of the book is an elephant. It's the old, Hindu or Buddhist parable about the 5 blind men and the elephant, where they touch a different part of the elephant, and one touches the tail and says it's a snake, the other touches the side and says it's a wall. But my point is, if you're looking at just one part of the way a company uses cash flow, you can come up with really misguided conclusions. And it's especially true in the United States since the early 80s, because there was a very real structural change when the U.S. government passed a rule that said, that gave companies safe harbor from buying back their own stock. And what you've seen over the past 30 years is that companies have moved to distributing their cash flows through a different route. So buying back shares rather than dividends. And that has created an entirely different way of looking at companies. And if you ignore the buybacks, and I could go on for this for a while, but if you ignore buybacks, you're making a very, very basic mistake, and you end up with, in our opinion, a much, much worse portfolio.
Now I could interject, and I saw this on your Twitter page, somebody asking about momentum as a return factor. Now, as you just kind of laid out somewhat, I know you're a quant guy too, but you laid out somewhat of a fundamental perspective there. Now, somebody on the other side could say, well, heck, I don't even need to know what the hell Tesla does, but I want to be long that beast.
Well, so, and the funny thing is, if you go and look at the 2 of the biggest, most famous financial academics, French and Fama, and they came up with, some very basic factors that work in equities, and we can get into trends and momentum in other asset classes, but they found value works, investing in small companies works, and then investing in momentum is the most profitable of all of them. And it's funny because you don't hear most of the academics talk about it as much, but it's of the small amount of factors they looked at the best. And so, and one of the reasons that actually the longboard guys talked about is that you have a lot of companies, that go down a lot, and you have these small amount of companies that go up a lot. And so your returns end up being determined by making sure, and this is one reason indexing works, and market cap indexing actually works, making sure you own these companies that are the 10, 20, 50, 100 baggers over time, the Apples of the world. But the nice thing about having a valuation anchor, and Apple is a great example, is that, and that's the beauty of capitalism. At some point, you get big enough where you get a target on your back, and other companies are trying to, come up with this creative destruction, and it happens over and over in time. And Rob Arnott out of Research Affiliates has some great research showing that if you buy the largest company by market cap, A, in the entire market, and B, in any one sector, it underperforms that sector or market by about 3% for the next decade. So when Apple became the largest company in the US, that's probably not a good investment. And in general, you look what's happened, it's gotten hammered. And so, and the same thing for top sectors. So look, we love momentum. And going back to this shareholder yield, this is a good example. If you sort companies based on dividends, it outperforms the market in the U.S. for as far back as you can find returns by, let's call it 2% a year. If you, and then in foreign countries, and then also sorting across countries. So if you sort countries by dividend yield, the highest dividend yield ones outperform the lowest. So it works great. However, because of the changes since the 80s, if you include dividends and buybacks, and we also include debt pay down too, but if you include a more holistic view of cash flows, this shareholder yield portfolio does better. And so it actually beats the S&P by about 4% per year. However, if you then combine, and we launched a new ETF on this a couple months ago. If you then combine the beauty of value and momentum, right? So you're buying what's cheap. So hopefully buying what's, $1 for 80 cents, but also what's going up. So you're avoiding, for example, one of the reasons all the dividend strategies got creamed in '08. I mean, some of those had dividend and dividend managers lost like 70, 80% because they followed these companies all the way down. But if you combine momentum, you end up with a much better portfolio because you're buying the cheap stuff once it's going up. And then at some point you rotate into something else that's cheaper and going up. And so Tesla is a great example of a pure momentum play. I don't think it'd be hard. Well, I'm sure Cole would argue the otherwise, but hard to argue the fundamentals being really cheap. But we like to come up with companies or countries or asset classes at that intersection of value and momentum. And I think that's the sweet spot.
I have to give an example to you that I saw this spring. I was presenting a trend following presentation to the Sovereign Wealth Fund of Malaysia. And it was interesting as I was presenting this presentation. And these are probably some of the people that have moved up the ranks to get to the position in their country to be making these very, important decisions on the country as well. And so there's two portfolio managers, and we got to talking about Apple, and they were strictly all value guys. Almost everybody I spoke to this spring, whether China, Japan, Malaysia, Singapore, all value guys, except Richard Chandler's office in Singapore, who have massive family office in Singapore. Those guys, they got all kinds of stuff going on. But the Malaysian office, the Sovereign Wealth Fund, the two portfolio managers were kind of like, the one was like, well, I just was too nervous and I had to take my profits long before it ever got to the 700. And then the other guy had somehow or another written it up, but he had no exit strategy, so he wrote it all the way down. And they were sitting there having this conversation amongst themselves about that they just didn't have a good technique. And the whole time I was thinking, I was like, wow, not thinking that the people in front of me were lacking any intelligence, but I was just thinking, wow, they really lack strategy.
Right. Yeah. A lot of people like to think that they have a process until something happens, right? So they like to think that they own Apple for XYZ reasons, but then it goes down 10, 20, 30, 40%, and they don't know what to do. Even though a lot of their original reasons haven't changed, they don't realize that they really actually had a process before going into it, because they never really conceived of the potential for it to, for example, go down. And you see so many investors that have a highly concentrated position in, say, their pension fund, where they then go invest their pension assets in their company they work for, Enron being a great example, but not having that exit or having a point at which you just say, all right, I'm selling, is a really tough thing to do. And, being able to invest in a company or stock market, you have to be comfortable with really large drawdowns. For a stock, you have to be comfortable with losing all your money in one position. Countries, it can get 90% same way, typically, with the exception of, the country confiscating the stock market, which has happened, Russia and China, et cetera. In general, asset classes in countries don't go to zero, which is why I think using mean reversion when they get really bombed out works better than, but with stocks, you have individual company risk, which is a little different. But yeah, for someone, and I talk a lot about this and often implying that it's a retail phenomena, that's an individual investor phenomena. It's not. like you said, you talk to people that are managing billions, in some cases, tens and hundreds of billions, and they have the same behavioral biases often. And the biggest one when you get to that scale is herding, right? Where they all chase into other asset classes and follow the performance of what's doing well. And so I go to a lot of these institutional conferences, and it's funny because the themes change based on whatever the hot topic of the day is. And 2007, it was, bricks and real assets because, we knew that inflation was coming and commodities and real estate were the place to be. 2008, 2009, it was risk mitigation strategies. Trend following was amazing. You looked at tail risk funds. What happens fast forward a few years? The big draw was risk parity, right? So everyone's talking about risk parity because what's happened? Well, you've had a 30-year bull market in bonds and the 10 years down to the lowest level ever. Of course, a high bond allocation looks great, and then lever that up. Well, what happens last few months? All the risk parity funds get hammered. So it's kind of rinse repeat, but you would think that at that level, most of the institutions would be a little more sophisticated in their process, but it's surprising and then not surprising to realize that it's just humans that are running it, but with a lot more money.
It's fun. When I was doing all these presentations this spring, like I said, it was mostly value-based mutual funds and sovereign wealth funds and some hedge funds, and it was mostly trend following presentations. And I would find that initially in the first few minutes, you could kind of see these value-based, a whole room of people be there, but you kind of see the eyes start to glaze over, for wherever I was going in my trend following presentation. However, I started to find there was one thing that would kind of make everybody wake up and snap out of it, is that when you would challenge them, and if I was able to look out the window, I was often in a conference room, I was looking out a window, and I'd remind them, hey, you might not be you might not become trend following traders. You might not have an allocation to trend following. However, outside that window right now, circling this building, looking to land, is the next black swan. I can't tell you when, I can't tell you how, but when it does, it's probably going to take a severe bite out of your fund. You could lose your job. And are you thinking about it? Do you have anything in place for that? And I have to say, after asking that question to at least 40 different funds in their offices, all I can say was that the reaction was the same reaction every time. Deer meet headlights.
All right. Well, the funniest part is when, I actually gave these presentations in North Carolina this week, and one of the guys who wasn't familiar with my firm, when I finished, he said, well, Meb, I see that you're a value guy, but have you ever looked into, other measures of trend or whatever? And I just kind of laughed because I was like, well, actually, the vast majority of what we do is more based on trend and momentum. But here's a good example. If you're talking to the value crowd, and you say, well, what percentage do you invest in market cap based index, S&P 500 or any foreign index? If not 100%, 90% will raise their hand. And you say, well, by definition, you're a trend follower, right? You're investing based purely on price, but in size, essentially is what it is. But you're based on betting more on companies that go up. And that's one of the beauties of indexing, right? Is that of these market cap indexes are essentially at their core momentum or trend type of indexes. People don't realize it, and they don't like to think of it that way, but that's what the market cap weighted space is. And so, you start to frame things a little differently for people, and they sometimes they get it and sometimes they don't. But in general, that's the whole point.
Trend following without an exit.
Right. No, yeah, it's just buying more of what's going up, which
it's a great strategy as long as, but once again, it kind of gets to not having an exit, not being concerned about the next swan to land. I think that's ultimately, if I can pass along a pearl of wisdom, I know with your firm, ultimately that's what you're trying to lead people to a place of like, hey, it's not going to always be just this buy and hold world. And what happens when it's not, and how much money have you lost, and how much more the hole that you've dug in the buy and hold, staying in that particular strategy. And I know you spend most of your waking time on these issues.
The biggest challenge for most people is that holding period and their lifetimes don't correlate with the time frame in which buy and hold needs to really, deliver the returns.
You mean to live forever? To live forever, you mean?
Right. So, most people operate on the quarterly or at most, yearly time frame or couple years. Rarely are they really saying, you know what, this money I'm not going to need for 10, 20, 30, 50 years, unless, it just doesn't happen. And so the problem is that markets, they can go up and down 20, 30, 50% in a year. And so you have these gyrations. It's totally doesn't line up with individual investor and even professional investors' timeframes on when they're looking at investing in money.
Listen, I got to let you go. I know you've got stuff to do. Tell me the best place for people can go. I know where it is, but I want you to say it. The best place where they can go keep up with Meb Faber.
Well, there's three for my company and the new ETFs we're launching. We're hoping to get out 5 to 10 in the next 2 to 3 years on a lot of these quant-based strategies. Is CambriaFunds.com. And then the parent company is CambriaInvestments.com. And then my personal blog and research is just Mebane Faber, MEBANEFABER.com, where most of the research will end up at one time or another. And the last one, the number of sites seems to be growing.
Are you up to 4 now?
I've
already lost track.
I have one called the Idea Farm, where we just send out basically all the institutional research that comes across my desk, interesting reads, and I'll sign you up later to take a look. But you get 2 or 3 per week of basically saying what's the most interesting things I'm reading from around the world. But those are the main ones. But you can find it on all different places, and hopefully we'll have a few more interesting pieces coming out in the next few months.
Go enjoy. I'm gonna get this outtake intro from these Vietnamese women added on the end though for you.
Okay, great.
We shall talk soon, sir.
All right, man. Have a good one. Have a good evening.
Okay, take care. Tonight on Michael's podcast is Mebane Faber. What do you say to Vietnamese?
Why don't you say it?
I just did say it. I want you guys to say it.
Okay.
Wow, cat got your
Cái này là cái
tongue.
gì? Nghĩa có gì? Có nên... Em đọc cái câu này á, đọc tiếng Việt cũng được. Speak English.
No, Vietnamese.
Nói tiếng Việt mà, chị nói đi, có gì đâu. Ôi, đọc gì chán á. Không, nói sao chị dịch cho em nguyên câu coi. Hả? Tối nay chưa? Tối nay. Podcast hay gì? Giống như là trên radio đó. Podcast with me.
Podcast, like radio?
Radio.
Yeah.
Like radio.
So tonight on Michael's radio show is Mebane Faber.
Mebane Faber.
Wow.
Cái này trên Michael là cái gì vậy? Hỏi nhiều quá nói đi. Chị phải chỉ em nói có tiếng Việt chứ sao?
You realize now what's happened is you realize as long as I live here, I'm going to be walking around with this recorder until you guys talk. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.